Sure. Well, yeah, you're right. Dave Ramsey hats off to him. I mean, he's created a machine that's helped millions of Americans, and my wife and I are a part of that. We got our focus on our budget because of him.
Yeah.
He helped us figure out how to give every dollar a job and to put that dollar to work. He helped us get relentlessly focused on our money, and I appreciate that about him. Mm-hmm. That does not mean that he wrote the fifth gospel or that he has some sort of corner on truth, because candidly he doesn't.
Are you tired of gambling your hard-earned savings with the casinos of Wall Street? Don't you wish you could generate passive cash flow from tangible assets that produce proven in-demand products? Our friends at Agronosotros allow passive investors to participate alongside them in their sustainable agricultural projects. So now you can caffeinate your cash flow with the second most traded commodity in the world after oil, coffee, and sweeten up your returns with high-end artisanal chocolate. Diversify your portfolio and participate in coffee and cacao farms in Panama that are turnkey, managed for you, with farming, processing, and product sales all done for you. And you impact the lives of subsistence farmers by helping provide housing and education through their socially sustainable programs. To find out more, go to wealthandfreedomnexus.com/coffee. That's wealthandfreedomnexus.com/coffee.
Are you tired of trying to keep ahead in the rat race, only to have so much of your hard-earned money going to the tax collector? Equity doesn't pay the bills. Retirement savings don't pay you now, and there are only 24 hours in a day to work. The only solution is passive income that pays you 24/7 now, not 40 years from now. From vetted investment opportunities to tax saving strategies, let John guide you through all the confusion and take control of your financial life in pursuit of financial freedom. So sit back, relax, and welcome to the Wealth and Freedom Nexus.
Taxes are your biggest expense. The best way to reduce your burden is real estate. Increase your income with amazing returns and reduce your taxable income with real estate write-offs. As an employee with a high salary, you're devastated by taxes. Lighten your burden with real estate tax incentives. You can offset your income with a W-2 job and from capital gains. Freedom Family Investments is the experienced partner you've been looking for. Our Real Estate Insider Fund is the vehicle. This fund invests in real estate projects that make an impact, and you can join us with as little as $50,000. Insiders get preferred returns of 10 to 12%. This means you get paid first. Insiders enjoy cash flow on a quarterly basis, and the tax benefits are life-changing. Join the Freedom Family and become a real estate insider. Start on your path to financial freedom through passive income. Text FAMILY to 66866. That's family to 66866. This is not a solicitation. Please text regarding this opportunity for complete details. This is for accredited investors only. Hey, welcome back to the Wealth and Freedom Nexus podcast. As always, I'm John Rickgarn, your host, investor, educator, and realtor. Now, if this is your first time joining us, thank you for the privilege of your time, and be sure to hit that subscribe button or the bell icon so you never miss an episode. And be sure to follow along on W Freedom Nexus. YouTube, Instagram, and Twitter handle are all the same. W Freedom Nexus. Boy, as I'm recording this is just after the 4th of July, and well, gee, where's the summer gone? Another side note, if you haven't signed up for my newsletter yet, be sure to click on the link in the show notes. That is a monthly newsletter, not weekly, daily, or damn near hourly, it seems like some others do, that I've had to recently clean out my inbox, block some people, report spam, unsubscribe, etc. It's just kind of amazing what some people, they find joy in. throwing spam out left and right, but to each their own. Again, I've mentioned to all my listeners out there, I will not spam you. I do not sell your email list to advertisers or anything like that. You're just going to hear from me for my monthly newsletter, and eventually going to have my weekly blog back up and running. Took a little hiatus on that with just all the other projects going along. So now this week's episode I actually recorded a while ago. In fact, actually, I was just re-listening to it, and it was in the midst of a snowstorm. I think this was the March one, if I remember correctly. I joked with my guests that I think we were on snowstorm 437. It was a very long winter here in Southwest Minnesota. I know by January, we were like 24 inches above the normal average of snowfall at that particular time of the year. And yeah, like I said, summer's about half gone, but definitely still the harsh memories of winter, and glad that winter is behind us. So, as I said, I was going through the show notes, re-listening to my interview with this guest, Mark Willis. He actually is another fellow podcaster, has a great podcast of the Not Your Average Financial Podcast. This is in my recommended podcast, which you can find at wealthandfreedomnexus.com, which I'm usually updating with, different topics and podcasts that I found interesting or thought-provoking, or share similar interest or, thoughts, if you will. Now, Mark and I got into a number of conversation side topics. He actually isn't too far from me, is in the greater Chicago area down by Illinois, and hence why they called the firm the Great Lakes, just, with the Great Lakes of America. And he's always been on a mission to really help untap people's financials destiny, if you will, and really just open up more avenues. Of course, we talk about that evil thing called whole life insurance, which Dave Ramsey just rallies behind. Actually, side note on that, since I mentioned it, even though I'm not even at 3,000 followers on Twitter, Dave Ramsey has blocked me, both my business and my personal accounts. So must be doing something right for him to take that step of blocking me. But, Mark and I got into a number of great discussions, whole life insurance, really how to manage cash flow. And I'll just leave this one teaser with you before we get into the main bread and butter. Is just think about this. If you've ever heard of the bank on yourself, infinite banking concepts, there's a couple terms that are being thrown out there. Just remember this, that even if you pay cash, Dave Ramsey's always like, pay cash for cars, pay cash for this, pay cash for big expenditures. Even if you're paying cash, it will still cost you interest. Now, if that seems to, twist your brain up a little bit, not understanding how that works, you'll definitely want to tune in, because once we dive into it, talk about the hidden costs that Dave Ramsey does not talk about when using cash to purchase everything. This could possibly open up your eyes. And like I said, it's been a while since I did a topic on infinite banking, whole life policies. Let's see, I think those are episodes 3, 14, and 45, if memory serves me right. So being that we're in the 90s for this episode, I figured it was time to touch base on this topic again. And it was great to connect with Mark via Zoom. We've connected on LinkedIn and other social media platforms, I think 4 or 5 years ago. I can't remember exactly, but it's been great to follow him, his business, his success stories, and so forth. So with that, we'll get into today's interview with Mark Willis after a word from one of our sponsors.
Check out the website simplepassivecashflow.com for podcasts, videos, articles, and free e-courses. If you guys have any specific questions, feel free to reach out to the team via email, and we'll get you pointed in the right direction, whether it be an educational course or information about syndication deals. If you haven't read my book, The Journey to Simple Passive Cashflow, click the link below to get a free copy. Thanks to John and the Wealth and Freedom Nexus podcast. Our team is here to help you take the first step, or if you're a seasoned investor, then we're here to expand your reach into alternative investing.
Hey, Mark, thanks for coming on the show. Are you dealing with this lovely blizzard we have here, or is it not quite into your neck of the woods yet?
Well, we're keeping it at bay for the moment. Okay. So, yeah, you mentioned before we hit record, you're in blizzard number 438 or something.
You kind of just lose count, and you think you're done with winter, and it's like Mother Nature's like, oh, no, you're not. And it just keeps adding. So, yeah, I think I know we're somewhere in the top 10 snowiest seasons ever recorded. And I remember in January, we were 24 inches above what we were normally at that time. So,
wow, right on. Well, I hope we can help thaw out some. How about this for a change of direction? We'll thaw out some financial myths and icebergs in people's wallets, and hopefully build some financial stability for their future around a warm fire of our great conversation.
Sounds good. Now, with that, Mark, from my listeners that maybe aren't familiar with you and familiar with Lake Growth, can you just give us a kind of quick background on yourself as well as your company?
Sure. Well, so I've had the great privilege, John, of working with real estate investors, business owners, even NFL Super Bowl champions. But most people I get to work with are just wanting some more agency and clarity of purpose in their life. They want more control over their finances. They're sick and tired of the kind of news that we're hearing almost on a daily basis now from our wonderful, overlords at different departments around the country here. And we want some kind of persistent, objective belief that we can actually achieve what we're working toward. There's nothing more frustrating with most people's financial plans than to be swinging that axe against a tree only to find out it's dull as a doorknob and it's never going to get the job done.
Right.
So most people's financial life, unfortunately, it feels as if they're sort of floating down the gutter of life and they're nothing more than a tennis ball trapped in its current. And what we try to do at Lake Growth Financial Services is help people swim upstream and take back control of their financial future. So that's what we do. My background, I personally started the firm Lake Growth Financial Services out of my own sheer terror of the financial crisis of 2008. I was working for a CPA at the time, and I overheard her making those dreaded calls. The call was, "I'm sorry, Mr. Client, you're 63 years old, but I just lost you a third of your life savings or half of your life savings, and you can no longer retire." I never wanted to make that call.
Wow.
And I almost got out of the business, to be candid with you, because it was such a devastating, terrifying prospect to have to make that call. And I was getting my feet under me, getting out of the student loan blizzard that I was in at the time. And at the same time, I stumbled across some strategies such as Bank on Yourself that helped give myself, my wife, and now over 1,000 clients across the country some peace of mind, stability, and capacity to become their own source of financing. And again, take back control over what was taken away from them.
Sure. No, yeah, great summary. And yeah, I can definitely sympathize with you there. I still remember my aunt, the previous Great Recession, the dot-com bust, where she had to delay retirement a couple of years because her financial advisor had a little bit too much tech stock exposure. So.
Yeah, right. Mm-hmm.
Now, you had mentioned obviously kind of the debt blizzard with student loans. And, I think there's good debt and bad debt out there. But, I think we both kind of share some opinions on a famous guru named Dave Ramsey. And he is always, live debt free, pay off all your debt, et cetera, et cetera, et cetera. But you've always said, there's something better than being debt free. Can you elaborate on what that is?
Sure. Well, yeah, you're right. Dave Ramsey hats off to him. I mean, he's created a machine that's helped millions of Americans, and my wife and I are a part of that. We got our focus on our budget because of him.
Yeah.
He helped us figure out how to give every dollar a job and to put that dollar to work. He helped us get relentlessly focused on our money. And I appreciate that about him. That does not mean that he wrote the fifth gospel or that he has some sort of corner on truth, because candidly, he doesn't. And nobody does. So what he takes take the good, leave the bad. So what did he get wrong? Well, I think part of his approach to finance beyond budgeting is dead wrong, candidly. All right. So I'll just tell you my story. So I was big time into debt. I was $120,000 in student loan debt, again, in the middle of the Great Recession when no one was hiring.
Wow.
And I had basically what amounted to a serious mortgage payment around my neck going to Sally Mae. I jokingly tell folks I married two women in college, my wife and Sally Mae, and we wanted her out of the house. So we started following the debt snowball method. You're talking about a blizzard outside. We're going to have a lot of snow metaphors in our conversation today. So we followed Dave's snowball method. And let me explain for those who aren't familiar. We would throw monthly minimum payments on all of our debts, except for the smallest debt. Now, some people dither and say do the largest interest rate, but we were just throwing it at one account. We'd throw everything we could at that smallest account. And once that debt was gone, we'd shift our focus. Our laser focus would be now on the next smallest debt. and knock that one out, snowballing after one after the other after the other. That was the Dave Ramsey model. And he also mentions to keep no more than about $1,000 in your emergency fund for this entire process. So, what could possibly go wrong here, John?
What covers what? Yeah, what can be covered by $1,000 nowadays?
Yeah, I mean, that's like almost half a dozen eggs right there.
Yeah.
So I was relentlessly pursuing this goal, but I was frustrated. Again, my axe was as dull as a doorknob because I was swinging that axe trying to knock out this debt. And every emergency we had, and as a young couple, you have a few, the car broke down, a medical emergency. So we would constantly fall back down the debt staircase, only to have to climb our way back up, only to fall back down again. It was very frustrating. We were making progress, but another wake-up call really shook me to my core. And that was when I realized, and someone had to tell it to me, Mark, you finance everything you buy. And even if you pay debt off with cash, you're losing what that money would have earned for you had you just invested the money and, not spent it on debt, throwing it into a hole. I felt at that moment this empty, like devastatingly empty feeling in my gut at that moment. And I realized I was in my young 20s, early 20s, and I was throwing away the most valuable dollars I'd ever have ever again due to opportunity cost. And when you throw $1 at a cup of coffee or a student loan payment, that $1 is gone, but also gone is the $9 or $15 that one would have grown to had we left it set aside, saved, invested, whatever instead. Is that anything there that you want to touch on or cover that?
A number of things. Obviously, the opportunity cost, $1 goes away and kind of loses the potential of what that dollar could have done. But, we don't have to go down that rabbit hole, but that's kind of one thing I like about Bank on Yourself whole life insurance, where you can essentially assign one or multiple jobs to $1 and utilize other people's dollars or other people's resources. So,
yeah, and your audience is familiar with this, and that's exactly what a professor of mine from college came and visited and told me about. I'd never heard of this concept before. And for those who are not familiar, go back and listen to some of John's other episodes because he's got some great content. But I'll just give you a primer. He told my professor came and visited, and he said, Mark, looked at me right in the eyes, and he said, Mark, is it possible that Dave Ramsey could be wrong about something?
No, he was anointed by God himself. Yeah. He can't be wrong.
Yeah, he was, writing the 11th commandments and bringing it down from Sinai. So exactly. No, I really thought that I had to take that. For the first time, I had to think critically about what he said about whole life insurance, which, for all of what I say about Dave Ramsey that I kind of poke fun at, he has really figured out the psychological twist to his marketing. And that's what he's doing. When he talks about whole life insurance, he gets you to feel disgust, which is a very powerful marketing emotion. Like, why would we ever feel disgust about anything financial? I don't care what you call it. You can call it a whole life policy, a 401k. You can call it a wet sponge. I don't care what you call my money, as long as I can have it do what I want it to do for me.
Yeah.
Right. So what is Bank on Yourself designed whole life insurance? I'll give folks the primer on this really quick.
Okay.
TGIF, I'll use that acronym. Okay. So T stands for tax-free. You can get the money accessible, tax-free, no taxes due if we designed it correctly. That's beautiful. It's like an unlimited Roth IRA in that respect. Second, the cash value, not the death benefit. I mean, there's a nice death benefit that grows, but the cash value in particular grows on a guaranteed basis, no matter what happens to the stock market, no matter what's going on in your real estate portfolio. Last year, we had a negative year in the markets, 30%, worst year since 2008. Every one of our clients that had whole life policies hit all-time record highs last year.
Yeah.
That's saying something.
Exactly.
When folks would have given their right arm just to not lose money last year, we were hitting all-time record highs. So G stands for guarantees.
Okay.
I stands for insurance. It is life insurance. So we can never forget how powerful that is. If I put $1 into my savings account and I died tonight, my family would get $1. If I put $1 into my life insurance policy and died tonight, my family gets, depending on my age, somewhere between $5 and $10. All that's income tax free.
Yeah. So
that's not a small feat right there. I mean, I don't know any other way to get that wealthy after I die other than being like a famous artist or something. So then fourth and finally, financing. And I believe, and most people tend to agree, and I'd love to know your thoughts, your need for financing is way greater than our need for life insurance. So our need for financing is greater than our need for life insurance. Why do I mean that? Well, your need to buy stuff, whether it's a car, vacation, kids' college, real estate investments, all the major purchases that you need to make in your lifetime, that's going to amount to millions of dollars. For me, it was first and foremost my student loans. But then I started thinking, well, if I just paid cash for my 12 cars I'm likely to buy, that's 6 for me, 6 for my wife over my entire lifetime. That's $1 million right there. When I consider opportunity cost, and we were just thinking small cars, but the opportunity cost of those cars purchased with cash was a 7-figure number. Yeah. And I started to get angry at Dave Ramsey for telling me to pay cash because you're still financing. Even when you pay cash, you're still financing everything you buy. Either you finance it with a dealership, the car dealership, and you pay interest to them, or you pass up interest you could have earned on that money had you left it invested instead. So I'll wrap it up with this, and I'll pass the ball back to you, John. But
sure,
when you borrow from these life insurance cash values, if it's designed the bank on yourself way, and I got to emphasize, there's a lot of misdesigns, poor engineering out there, as you know. But if it's designed properly, you can borrow against the policy, and it will continue to grow and compound as if you hadn't touched a dime of the money. So if you've got $100,000 of cash value and you borrow $80,000, like we had a client yesterday, she had $113,000 of cash value, and she had a loan for $80,000 against that policy. And yet the cash value was still growing, even on the $80,000 she borrowed to give her the guarantees plus dividends on the full $113,000. That to me spells uninterrupted compound growth. And it's actually the most powerful financial tool we can have in our tool belt.
Huntsville, Alabama, the Rocket City, the Star of Alabama, the most populous city in Alabama, ranked as the best place to live by U.S. News and World Report. It's also a great place to invest in, and best of all, it is the place for this year's Spartan Summit by Spartan Invest. Join me and many other investors as we tour the Huntsville market with the Spartan team. Learn what sets their property management and turnkey services apart from others, and why they have been consistently ranked on Inc. 5000's fastest growing companies. Go to SpartanInvest.com today and reserve your tickets. Best of all, use promo code WFreedomNexus for 15% off your tickets. Join me October 4th through the 6th in Huntsville, Alabama, and unlock your legacy with Spartan Invest. Agreed. No, and yeah, you touched base on a number of points on there. I mean, I've utilized, my policies. I still remember, and if you're listening to this, shout out to you, Barry Brooksby, a great friend and mentor of mine for many years. But I think my first cash value increase, I think was like $13. I got us like, yippee-i-yo-ki-yay, let's book the cruise right now. But it's like, okay, steadily, pay those premiums, the paid up additions rider, et cetera, et cetera. And, fast forward, here we are in early 2023. And I was just looking at the numbers. I'm like, okay, the cash value is going up over $700 a month now, times that by 12 months, that's over $8,000 a year. And you kind of mentioned like a Roth IRA. Well, good old Uncle Sam says, if you're even eligible to contribute to a Roth IRA, you can only put $6,500 in a year. That's it. Well, just the cash growth of my policies is more than the max amount that I can contribute for a Roth. And
wow,
that's if I make $1, that's if I make $10 million and anywhere in between. The second thing I always liked about the whole life, like you said, borrowing, and, I've gone over this with other videos and podcasts, but I'm just throwing it out. If you have a $10,000 cash value and you say, yep, I need to take out a loan, let's just say $5,000. There's no credit checks. There's no copious paperwork. You basically, my experience, I fill out a form online, I send it in. 3 days later, it hits my bank account. And on top of that, that cash value, that just keeps growing, where I don't think a lot of people understand if like, well, I got a HELOC, I got a credit card, I have a business line of credit, whatever. It's like, overnight, and I've had this happen personally. Oh, you have a $10,000 credit line? Well, due to uncertainty in the market or whatever banking euphemism they want to give, we're going to cut that down to $5,000. So we just cut your credit line in half overnight, and they might give it back, they might not. And I think that's probably an unspoken power a lot of the banks have over us that not many people talk about.
Well, that's part of that feeling of out of control that I hear in the subtext of people when I first meet them. They just feel like someone else has the dial on the temperature in their aquarium, that they're just a little fishy floating around in there, and somebody else, i.e. the banker, is the one jacking with the interest rates, i.e. jacking with the liquidity, the access to capital. I mean, Mark Twain is the guy that said it. You know, a banker is a fellow who will lend you his umbrella when the sun shines.
Want it back when it's raining. Yep.
Yeah, you got it, man. Yeah. So we had this aha moment with my professor there, and it took me about 7 months to wrap my brain around it and get over my own skepticism and to kind of put Dave Ramsey in his place in my own mind. But we did. We started using the policy to pay off our student loans, and we eventually paid them all off that way. And then we, over that period of time, we started our firm, Lake Growth Financial Services, and we started helping other people, not just pay off their debts, but actually use it for real estate investing, for kids' college. I mean, the application is infinite.
Yeah. Well, and I think you touched on another point too, where I think, the Dave Ramseys, the others out there, they have such just a negative stigma on debt entirely. And, I always think back to a Robert Kiyosaki discussion. He always said, like, well, what if you could borrow at 6%? It's like, oh, that's bad. 6% interest, that's money out the door. Like, okay, well, let's just say you take that money at 6% and let's be conservative. You invested at 9%, create a 3% arbitrage. And then kind of starts to get their minds working. It's like, if you had that, then how much money would you like to borrow? Well, then the answer should be as much as I possibly can.
That's right. That's right.
Making money with other people's money. So one thing I did kind of want to touch base for going to the next topic. I've always kind of used the car analogy. I don't know what your thoughts are, but I think Dave Ramsey, he always kind of looks at, very narrow focus with whole life insurance, kind of like the, back in 68, 72, the Ford Pinto, that was a horrible car. Understandably so. But because of that, ergo, all Fords ever made, all exist, and ever will be created into infinity are bad. So therefore, no one should ever buy a Ford ever again. Would you say that's maybe a little accurate on his take on it?
Yeah, that's how he gets you into that feeling of disgust, and there's a certain bias. Now, what he doesn't say is, hey, by the way, I'm the guy over here selling you a Chevy.
Yep.
And what does he sell? He sells, well, his biggest advertisers are term insurance companies and mutual fund companies. So, if you ask a barber if you should grow out your hair, what his answer is going to be. It's
like, no, not at all.
Yeah. So ask a Chevy dealer if you should go buy Ford, and you know what their answer is going to be, right? So I have nothing but respect for the man who's built a great business for himself, but do not take him as your financial advisor. He should not be your financial guru. You should not have a financial guru just spouting marketing shticks off a radio broadcast. You deserve more than that.
Okay. Now it kind of brings up another topic I want to mention. And, Dave Ramsey, to be fair, he's not a financial advisor, so I know he can't give advice per se. But he's always touting these magical 12% mutual funds that, $100 turns into 112, turns into 120 odd, and so on and so forth. But you've kind of relayed some research of what the actual real rate of return for the average stock investor is. Can you elaborate on that?
Sure. Yeah. Well, okay. Let me do a little fun experiment here.
Okay.
Let me give you a 25% average rate of return.
Yeah.
Let's double what Dave's purporting to give us. Because he says it's easy to get 12% average rate of return. You can fall off a horse and just get 12% on your mutual funds.
Yeah.
Now, I just want to do the math on that. And I wonder if anyone else has. So let's do it. Let's say you had $10,000 to invest.
Okay.
And you put that into a magical box that was going to, some sort of magical investment. And it gave you an incredible 100% rate of return in year one. So we doubled our money. So your $10,000 went up to $20,000.
Yeah.
You got it, man. You got it. So now in year two, we're loving life. We're like, man, let's keep doing that. So you pull the crank again. And unfortunately, in year two, you lose 50% of your $20,000. So your 20,000 is back down to
10,000.
Yeah, what we started with, right?
Exactly.
We're 2 years older, and let's not count inflation and all that, but
Yep.
how much wealthier do you feel?
Nothing, because it went up by $0.
But wait a minute. Let's do the math there. I just gave you an average rate of return of 25%.
Yep.
100, minus 50 divided by 2 years is 25% average rate of return.
Exactly.
Now, the real rate of return was 0. Your compound
before
annual
inflation,
growth
but
rate. yeah, before inflation. If we count that, and don't forget, this has probably a fee associated with it.
Yeah.
So there's that too. But let's just pretend that those don't exist in this scenario. We had a 0% real rate of return, but an average rate of return of 25%. Now, here's what gets me angry. The SEC allows mutual funds to advertise average rates of return.
Yep.
That is a crime. That's, I think, wrong. Why am I so bothered by this? Because as a certified financial planner, it misdirects people. It's like a magic trick. It's like a magic trick. If you tell somebody you can expect to get 12%, heck, even 6%, and then you're planning for that your entire life. Oh, let me punch that into my calculator here. I'm 32 years old. I'm going to save X dollars. I'm going to have Y dollars at retirement. And the real returns are much lower than we expected. And we're SOL there, right? We're sorry, out of luck. And now we don't have a way to go back in time and fix that problem.
Right.
Life is like a roll of toilet paper. It only goes one direction.
And I like that analogy.
The more you use it, the faster it goes too. So finally, let me kind of get to your question. What was the real return of actual investors? Now, I like to use a 30-year time span over the markets, because that's likely a long time for most people's lifespans, their retirement, their working career. And that also gets rid of, blips in the radar like we had in 2020, or like we may have had last year in 2022. So let's get a long-term perspective. And that will include, the 90s, the bull markets, and some of the bear markets like 2008. But let's look at a long term. Now, what kind of rate of return, John? I'm going to put this on you for a minute. To deal with all the drama and all the stupidity that we've seen in the stock market over the last 30 years. You said .com, the real estate crash,
Peloton stock, I could go on forever. Yeah.
Meme stocks. Yeah. How much would you be willing to, what rate of return would you require to put up with that nonsense for 30 years?
For me
5%,
personally, I'd have
10%?
to say minimum 10%. So
yeah. All right. Yep. So me too, to kind of put up with all that. The real return, according to third-party research, so these are guys that don't have a dog in the fight. This is Dalbar, Dalbar. Every year, they put out a report using third-party research of actual investors. The report, if you guys want to look it up, it's the QAIB report, Quantitative Analysis of Investor Behavior Study. Every year they bring it up.
That just rolls right off the tongue, doesn't it?
Oh, sure does. Yeah. Yeah. It's one of those wonderful acronyms that I think folks just pull, alphabet soup up just to see what they can put together. But yeah, that's the study. And the real return of folks who had an asset allocation fund in like your target date funds, your index funds, watching an index should just track the index. Over a 30-year period. Here it comes. The real return was 3.98%.
Jeez.
That's pathetic.
Yeah.
And that's if you had no bonds or bond funds. It was all equity, index funds, etc. And that's before taxes, by the way.
Yeah.
So if you had that junk in a 401k, that means, a good chunk of that's going to be taxed too.
Yeah.
So that's going to lower your return even more. So what do you think about that? Does that shock you as much as it shocked me?
Well, when I first heard it, yes, but I've heard it multiple times now, and I've seen some slight variations, which I know you said they come out with us every year. So, I think the highest I heard was like 4.1%. I can't remember, but regardless, lower than the rate of inflation, real, transitory, or otherwise, I think it's pretty bad.
Yeah. Well, and it depends. If you've got a blend of stocks and bonds, like most people do keep, that's going to lower your return even more.
Yeah.
And, if you're getting closer to retirement, then you're likely heavier into bonds, which again, lower. That number was as good as it got for 30-year investors. So I'm shocked that we all put up with that mess. And investors are listening to their investment advisors. Again, it's like asking the barber if you need a haircut. We know the answer. So these guys are telling you, just hold on. know, it'll always come back. You know, don't look at it when it's hurting you. I mean, candidly, this is sort of how we talk about abusive relationships. You know, it's your fault you're in this position. You know, don't look at it when it's hurting you. So I think, honestly, there has to be a reckoning with how we deal with this thing called money. And for me and my part, I have a little money in the markets. That's fine. It's money I can afford to lose. But I have the majority of my wealth in contracts, insurance contracts that are guaranteed to grow every year and not be beat up by market volatility. I've got tremendous liquidity, so I can sit on my policy's cash until the next, you know, news breaks that there's going to be a downturn. And then you and I, with our policies, will be the ones at the courthouse steps buying up some real estate.
Exactly. Or the next stock that gets, you know, unfairly beaten or whatnot. And, you know, you mentioned the bonds, and I always kind of chuckle. I think they have a place. You know, there's good and bad with anything, but especially the U.S. Treasuries are like, oh, it's a risk-free return. I'm like, yeah, go ask the executives of SVB or Silicon Valley Bank of how risk-free those Treasuries are. Exactly.
Right. Exactly, man.
Yeah. Now, you had mentioned a little bit earlier, obviously, you know, Dave Ramsey is very into the debt snowball, but can you elaborate on what exactly the debt snowbank is that you've mentioned numerous times in your podcast?
Oh, sure. Yeah. The snowbank. So we've been talking about blizzards and snowballs. Now let's talk about a snowbank.
Here.
Yeah. So given all this snow we're having, let's kind of talk about this in terms of an alternative to the debt snowball method. And that's actually, you know, it's a fine metaphor because the snowball is what, you know, again, Dave Ramsey's idea is get you going on paying off your debts. The problem I had was I was throwing away my best dollars that I'd ever have again. And it was going into a hole. And then from this point on, we have a $1,000 emergency fund that will keep us falling back into debt. So let me talk through very simply, and I'll do this fast and then we can break it down. The 4 steps to the debt snowbank method. And we trademarked that. And it basically is identical in step 1. We still want to pay our minimums on all our debts. Don't want to go behind on any debt. So we're paying our minimums on all our debts. Step 2, instead of throwing all your extra cash toward a smallest loan that you might carry, like I did, instead point that extra money you can save each month toward a whole life policy. Design the bank on yourself way. So now we're flooding that policy with as much cash as we can, challenging ourselves to just pack money into our own bank rather than somebody else's bank. So we're building up our cash value very fast as our student loans or our car loans or whatever it is coming down very slowly. We're only paying the minimum, so those won't come down very much. But our whole life policy is just shooting up like a rocket. That's step 2. We overfund our policies. Step 3, we borrow against the life insurance and pay off the debt, one after the next, after the next, after the next. And then step 4, remember, our policy is continuing to grow and compound just as if there was no loan. So, and then step 5, I guess there was a step 5, we repay the loan to ourselves at our own schedule. So there's no required repayment plan with this policy. You're in control. You control the dial on your aquarium. And those are the 5 steps to the debt snowbank method.
Gotcha. Yeah. And just for a little tip for any listeners out there too, if you're thinking like, well, you're just paying one debt off or shifting it. Little fact, the cash policy loans don't report to your credit report like your Chase, Citibank, Wells Fargo, et cetera. So,
yeah, that's right.
All right. Well, this has all been very interesting, Mark, and I wanted to thank you again for coming on my show, you know, sharing your story and obviously all the resources you have for my listeners. If anyone out there listening wants to, you know, get in touch with you, learn more about the debt snowbank, and like you said, just get more control over their liquidity, their finances, and their financial situation, what's the best way to reach out?
Yeah, if you want to have some more control over your finances, if you're tired of seeing ugly surprises on your account statements from your retirement accounts, or if you want to take more control over your real estate purchasing and, you know, get rid of the banker in your life, then I can help. You can reach me at kickstartwithmark.com. That's kickstartwithmark with a K.com.
Nice. Okay.
And happy to speak, do a 15-minute phone strategy session, answer any questions folks might have.
Sounds good. Sounds great. Yeah. And for those listening, as always, we'll have these in the show notes as clickable formats, so you don't have to find a pen and paper while you're washing dishes or driving or whatnot. So with that, Mark, I want to thank you again for taking time out of your schedule, and best wishes with the next snowstorm as it makes its way towards you.
Thank you. You too.
Thank you for listening. Be sure to share, rate, review, and subscribe on your favorite podcast platform. For more updates, check out www.wealthandfreedomnexus.com. Remember, nothing on this show should be considered tax, legal, investment, or professional advice. This show is produced solely for educational and informational purposes. Please consult an appropriate and licensed tax, legal, real estate, or business professional for specific advice for your situation. For distribution or publication rights or media interviews, please contact the host.